If you don't want to have to work for the rest of your life and wait for payday every month, then let's talk about how you can build your own money machine that keeps paying you month after month, but without you having to lift a finger, and that at some point can even replace your active income completely. Wow, that almost does sound too good to be true. And of course, there's a catch, but I'll get to that. I'm talking about a dividend portfolio, and here's the thing. My mom recently retired, and I wanted to find a way for her to get paid monthly now that she doesn't have an active income anymore. And that is like additional to pension and stuff. Now, my own multiple six-figure net worth is only partly invested in a dividend strategy, and I will tell you why in the end. But for now, let me real quick over the basics so that we start on the same page. Then I'll tell you what I did to build a monthly paying portfolio. And then third, how you can build your own monthly paying portfolio in 4 steps. If you're new here, I'm Sophia, a German doctor who loves to talk about money. On this channel, we explore the strategies how to build wealth without living frugal and dividends paying for our non-frugal living. Doesn't that sound exciting? So just real quick, the basics. Dividends are a profit that a company shares with its shareholders. Meaning that when you own a stock, you own a little piece of that company. And then when the company decides to share their profit or distribute part of their profit with their shareholders, then you get paid. Now, not all companies pay dividends. Others decide to reinvest their profit into the business instead. Now, when we look at it, dividends are the ultimate form of passive income because you really only buy the stock and then you get paid for owning the stock forever. Okay, that is until the company exists, and also as long as the company decides to pay out their profit as dividend. And that brings us to the catch because, of course, as shareholder from one company, we always have the market risk because the company can go bankrupt. And we also have the dividend risk because the company can decide to not pay out their dividend anymore. And that can be because they need the money otherwise for survival, or also because maybe they didn't have that much profit. Now, you can buy dividend stocks in 2 different forms. One is as single stocks, which means you directly buy shares from companies like 3M, Procter & Gamble, or Johnson & Johnson. Those were completely random examples of dividend-paying companies. Now, the pro of buying single shares is that you can keep all the dividends to yourself, except for taxes, of course. But the con is you have to choose the single stock. That can be overwhelming if you have hundreds of stocks to pick from. You might also need larger amounts of capital in order to buy those stocks and also diversify enough. And always with single shares, you carry the full market risk. Means when the company goes bankrupt, your money is gone. And the second option is to buy them as funds. And in a fund, several different dividend stocks are bundled together in one financial product. Now, the pro of a fund is that you're automatically diversified over several different companies. That also means you can start with smaller amounts of money and still have the full range, like the full range of different dividend-paying companies. And you have also a lower market risk because if one company in that whole bundle goes bankrupt, it just gets replaced by the next one. Now, the con of funds is that they have yearly costs, which means you still get paid the dividend, but minus the costs. I'd say that is quite theoretical because if you choose a low-cost index funds, the costs really are negligible. And I personally think with a fund that the benefits outweigh the costs. But of course, our goals with the dividend strategy is to get paid and also is to get paid as much as possible. So still keep an eye on those costs and keep them as low as possible. Now, the problem with single stocks as well as funds is they pay out the dividend quarterly, at least in most cases. That means if you invest in one dividend fund only, that also only pays out quarterly, then you only get paid 4 times a year. And although that's not bad, I wanted to create a monthly income stream for my mom. And I also definitely wanted to go with funds because of the diversification and the lower risk. There are also funds that only pay yearly or half yearly, but that's not so often. There are also funds that pay monthly, but that's also not as often. And then my thought also was, okay, if I only look at the ones that are paying monthly, that I'm quite limited in my choice and maybe also limited in, the range of diversification. So here's what I did to build a monthly paying portfolio. And by the way, I discovered this in a YouTube video of a German finance channel. So what I did, I looked for funds that pay quarterly but in a different rhythm. So most high yield dividend funds do pay quarterly, but some of the funds pay out their dividends in the beginning of the quarter, meaning in January, April, July, and October. Other funds pay out in the middle of the quarter, so in February, May, August, and November. And there's also funds that pay out their dividend in the end of the quarter, so in March, June, September, and December. So what I did, I selected 3 different funds, each with a different rhythm. So one pays out in the beginning of the quarter, one pays out in the middle of the quarter, and the third pays out at the end of the quarter. And that way, my mom gets paid monthly. Now, because those are different funds, they don't pay out the same amount every month. But either way, what gets paid as dividend can vary. It can vary from quarter to quarter or also from year to year. And now here's how you can build your own monthly paying dividend strategy in 4 steps. Step number 1 is to go to a website where you can research the funds. So I mostly use justetf.com because I live in Europe and that's a very reliable and nice interface research option. Now that is for European ETFs because there are special regulations regarding investments in general and also ETFs in the European Union. If you're outside of Europe, you could use Yahoo Finance, or I also found ETF.com. Or what you can also do is when you already have an investment platform or a broker, you can just use their search option. And then you type in search words like high dividend yield or dividend yield. You could also look for aristocrats. Aristocrats is a famous dividend investment strategy, and aristocrats are companies that have paid out their dividends over the past 25 years. And not just that, but also kept those dividends stable over this time period. Step number 2 then is to note the name and also the ticker symbol. So when you do your research, just pick a few names from everything that pops up in your search. And to note the ticker symbol as well just makes it easier afterwards. Then step number 3 is look for the distribution frequency, the dividend yield, and also the cost. Now, depending on which website you use, sometimes you have this information within this website you research. In other cases, you can just take the name and the ticker symbol and Google it. And then you can find a fact sheet with all this information. And you can also just go to the website of the issuer of the fund. So for example, if you find a Vanguard fund, then you go to Vanguard, or if you find an Invesco fund, then you go to Invesco. And then you can research further there. Now the distribution frequency will tell you how often the dividends get paid out. So is it yearly, half yearly, quarterly, or monthly? And if it's anything else than monthly, you can also look up at which date it gets paid out. That will be important for later. Remember, in the beginning, in the middle, or in the end of the quarter. The dividend yield is how much money you actually get paid for your buck. So obviously, the higher the dividend yield, the better for us, because then we get paid more for what we invested. But of course, if it were that easy, usually this goes to the cost of diversification, because not that many companies pay out a super high dividend yield, or also not all the funds have a super high dividend yield. I would say everything over 5% would be excellent, but also 3+% is fine. And also the dividend yield is not necessarily the same every year, so keep that in mind when choosing. And then I think even more important is the cost, which is the TER, the total expense ratio, and this is the cost that the fund costs over a whole year. As always with costs in the whole personal finance universe, aim for as low as possible. But also what I found is that especially when you want to have a high dividend yield, then the trade-off for that can be a higher cost of the fund. I'd say it should be less than 1%, definitely. I don't own any funds that cost more than 1% per year. Less than 0.5% is excellent. And then step number 4 is choose a selection of funds so you get paid monthly. So that means go through all of the funds, all the ETFs, the index funds, whatever you found, and then group them together in a way where our 3 main factors, the distribution frequency, the cost, and also the dividend yield, are aligned in the best way. Of course, if you find one that pays monthly and you also like the one that that pays monthly as for the dividend yield, the diversification, and also the cost, then you can go just for one. If you're okay with at least 3 ETFs or index funds, then you can do it like me and select the ones that are paying in the beginning, middle, and end of the quarter. And then buy the funds. And that's already it. If you try it out, would love to hear how it goes, so let me know in the comments. And here's the reason why I have personally not put much of my own portfolio into a dividend strategy. And one of the reasons is that I want to max out compound interest because I still have a very long time horizon. So whenever I look for an ETF or a fund, I look for accumulating ones, which means that everything gets reinvested. And I don't want just the reinvested dividends to compound because, of course, theoretically, you could also buy all these dividend stocks or funds and then reinvest the dividends if you don't need them. But I also want like the capital gains to compound. And the way that I look at this is that when you only choose like dividend paying companies, it's like neglecting the part of the market of the companies that don't pay out a dividend, that reinvest them instead. And that is also one of the usual arguments between a dividend strategy and let me call it non-dividend strategy. The trade-off of a dividend strategy is a higher volatility. That's definitely something that you have to keep in mind, that your goal with the dividend strategy is not the capital gains, but it's to get paid on a regular basis. Because usually when the company pays out the dividends, there's a little drop in the stock price. And another argument is also that because they pay out the profits, the performance over longer periods of time is not as good as the ones who reinvest their profits. On the other hand, especially from a like money mindset, psychological side of looking at this, I definitely start to see the benefits of getting paid from your portfolio, because selling your investments in order to live off of them can be a hurdle, a psychological hurdle. And with dividends, you just have that immediate passive income, and then you can decide if you want to reinvest it or just spend it. And I would also totally understand the argument of, you know what, I don't want to max out the profit. I prefer to get paid on a regular basis and therefore like miss out on what would be possible because that's just more important for me. If you want more inspiration for specific ETFs to invest in, you can watch this video here next. Otherwise, thank you for watching and I'll see you in the next video. Bye-bye.